What if there was one thing that you don't understand today that turns out to be of enormous significance to your future and the future of all mankind? Wouldn't you like to know that one thing? What if that one thing would change your behavior and alter your decision making for the better for the rest of your life once you understood it? What if that one thing would also cause everyone else to alter their behavior once they understood it in predictable ways? What if almost nobody truly understands that one thing yet? Wouldn't it be valuable to know that one thing before everyone else? Yes, it would. It would be enormously valuable. What would you sacrifice to understand this one thing? Would you pay to know it? Would you spend your time? Would you study and learn about this most important thing? If you want to know, if you are ready for this knowledge, listen up. In the late 1990s, I was working in Boston as a software developer where I was building portfolio management systems for large asset managers. It was there that I was introduced to something called the efficient markets hypothesis. You probably know about this. The basic idea of that efficient markets is that markets reflect all of the available information in current prices. One of the oft-repeated supposed implications of this is that it is impossible to beat the market on average. Maybe that is true on average, but you only need to beat it once. The efficient markets hypothesis is usually trotted out as a marketing trope for passive investing in index funds, something that has actually become problematic for our market structure, but that's on a different topic. Fortunes are built on a single winning trade made with conviction or a single business investment nurtured to a success. Concentration over time builds wealth. Diversification preserves it. Passive investing in index funds is fundamentally a store of value activity and a diversification exercise. The simplistic take on the efficient markets hypothesis always struck me as bullshit. Otherwise, insider trading wouldn't be a thing. It's obvious that knowledge undergoes a diffusion-like process. Some people have it and some people don't, and it spreads from the people who have it to the people who don't. Everybody knows things that others don't. A keen insight starts with a single individual or a small group. Awareness spreads slowly, and often the information or knowledge is in the open and published, but people are not aware of it, they have not accepted it, or they don't know how to apply it. People think that if you have a really good idea, everyone will jump on it. The truth is, if you have a really good idea, you'll probably have to beat people over the head with it to get them to accept it. Lots of people are about to get a beating they will never forget. In 1973, Fisher Black and Myron Scholes came up with their famous equation for pricing options. They published their result academically. It was there for anyone to read and to make use of to make money, but almost no one did for a decade or more. Eventually, lots of hedge funds did make money by applying Black-Scholes and various extensions to their model. They eventually won the Nobel Prize for their work. This is an example of knowledge diffusion. In 2009, Satoshi Nakamoto anonymously published the Bitcoin white paper. It's been sitting around for 10 years, but outside of a relatively small number of cryptography nerds, libertarians, speculators, miners, chip manufacturers, energy producers, and energy thieves, few have really absorbed the implications. Many people use Bitcoin for short-term purposes of value transfer, but very few of these users understand the big picture. In 2019, another anonymous personality, Plan B, at 100 trillion USD on Twitter, published a short Medium article detailing a statistical analysis he performed on the relationship between the stock to flow of Bitcoin and other monetary commodities and their overall market capitalization or total value. The stock to flow ratio of Bitcoin increases over time according to the algorithm in the open source software. It rises slowly with every block the network produces, every 10 minutes or so, but it doubles every 4 years in a step function with an event called a halvening. Each time it occurs, this process halves the production rate of new Bitcoin. And while you cannot predict the exact price on any given day, the smoothed average of the total market value of all Bitcoin, its expected value, can be calculated as a function of the stock to flow at a given time in the future. Consequently, we can predict what the market price of Bitcoin ought to be on average, give or take, well into the future. That sounds useful, doesn't it? You can't do that for stocks because you don't know what management will do or what the competitive landscape for a given firm will be in the future. You can't do that for bonds because you don't know what interest rates will be or what the purchasing power of the money will be. You can't even do that for gold because, well, the gold supply could change. We might find an asteroid full of gold. It could be outlawed and confiscated again as it was before, or it could be suppressed and manipulated with paper gold securities. This ability to calculate the expected value of Bitcoin in the future is what is known as the stock-to-flow hypothesis, or S2F. You might intuit something like the S2F just from reading the Bitcoin white paper, or the book The Bitcoin Standard, where stock-to-flow is discussed in some detail. But the stock-to-flow hypothesis from Plan B entails the discovery of a power law, which has this predictive power. Power laws are very rare in nature. Power laws predict things like the frequency and strength of earthquakes, the size and destructiveness of human wars, and the orbits of planets. Wait, what? Bitcoin has something that belongs in that category? Is this a genuine discovery? Yes, it is. It's genius work piled on genius work by anonymous authors following up anonymous authors. It is a hypothesis, which means that it is not proven. It is, however, as statistically sound as those relationships found in other natural phenomena. Recent work attempting to refute the stock-to-flow hypothesis found a co-integration relationship between the price of Bitcoin and the stock-to-flow ratio. This supports the conclusion of Plan B's statistical regression model. There is no way to prove that the price of Bitcoin will move as the stock-to-flow models project. We have to wait and see. Human events will cause temporary variance from the model, but it seems highly probable that it will move as predicted, like very highly probable. This is what people find so hard to accept. Conventional thinking tells us you can't predict prices and that the so-called risk-free rate of return is properly based on the short-term debt of bankrupt governments in the most manipulated market ever. Is that really the risk-free rate? Then this is used as the basis for evaluating the risk of various securities and the real risk-adjusted returns of various investments. It's built on fluff. It is a house built on sand with a Cat 5 hurricane approaching. But what if you had something that within a certain range of variance had predictable yet increasing value well into the future? We all know how gold has preserved its purchasing power over thousands of years. It has done so because it has the highest stock-to-flow of any commodity. Gold's net production rate, the flow, approximates overall population growth over recent human history, about 1.8%. It has been the case that if you have some gold, your share of the overall per capita gold stock will be roughly stable over decades and centuries. Thus, your value is preserved across time. But what if this new thing had some predictable increase in purchasing power rather than simply stable purchasing power? What if its stock-to-flow was higher than gold and rose at a predictable rate? What if that new thing was like physical gold, a bearer asset that did not represent anyone else's liability? Well, that would become the new ruler by which you measure and judge all other investment and consumption activity. It would be the null hypothesis. It would the do-nothing investment. Owning it would be the new sitting on cash, obviously, since Bitcoin is becoming money. It would maximize your optionality well into the future as long as you are flexible about when you need to draw upon it. Like maybe you could wait a year or two to take advantage of an opportunity. It works as long as you lower your time preference and have other resources to deal with emergencies. That's what happens when Bitcoin becomes your unit of account. The fact that people do not understand stock to flow means that Bitcoin is horribly mispriced. Smart guys know this. People like the famed VC Tim Draper, who years ago bought at auction all the Bitcoins the US government seized from the Silk Road, an online black market. The efficient markets hypothesis does not apply here. You can use this to make your own bet, to take a position that would alter your future and that of your children and your children's children down the line in a significant way. And you don't have to bet the farm. A bet as small as $1,000 today could be life-altering money in 10 years for most people in the world. A portfolio 1% allocated to Bitcoin and 99% in cash would beat a 100% index allocation over a multi-year holding period with far less downside risk. But a position of $10K or $100,000 in Bitcoin would be generational wealth, or you could even land you in the ultra high net worth category. In fact, if the stock to flow hypothesis holds, there will be tens of thousands or even 100,000 new ultra high net worth families due to Bitcoin. It will be the largest wealth generation or transfer ever in history. In 10 years, fully half of the ultra high net worth individuals worldwide may owe their fortune to Bitcoin. You want to get on the right side of this, either to protect what you have if you're already wealthy, or participate and alter your family's destiny if you are not. Although humanity as a whole should be much better off with Bitcoin, you as an individual need to at least accumulate a little now to ensure you are not poor in the more prosperous future, should the stock to flow hypothesis hold. I know just how hard it is for even smart people to accept this. I have friends who are sophisticated businessmen and investors who still own no Bitcoin, even though I have told them about it for years. You have to beat them over the head with it. Well, that's what I'm trying to do here. It's possible that stock to flow doesn't work and none of this materializes. But that is not a reason to dismiss it. If there is a chance, a significant chance, that it is valid, and I urge you to do your own research, the implications are so profound that you have to incorporate it into your planning. Your business planning, your financial planning, all of it. It's quite possible that your decision to buy Bitcoin now will eclipse all of the hard work and creativity that you put into building a business or a career, diligently saving year in, year out, and carefully selecting investments over decades. Maybe the whole purpose of all that activity was to put you in a position so that you could safely make this trade. It is possible that your decision not to buy any Bitcoin when you were informed could undo and undermine all that you have worked to accomplish, financially speaking. Wealth is not just absolute, it is also relative. I'm trying to save you from future debilitating depression. One of the principles I live by is to minimize future regret. You may already regret not buying Bitcoin years ago. This regret keeps people from moving forward with a rational choice today. Regret is what you will feel when you explain to your children or grandchildren why you didn't buy any Bitcoin when you learned about it. I recently asked my dad why he didn't buy stocks, and especially bonds, in the 1980s. Reagan was in, it was springtime in America. Everyone of his generation, and even the baby boomers, the younger ones, who did buy, they made money hand over fist for decades. It was a 40-year bull run. You didn't have to save much back then to be in a pretty healthy position today. He gave me some excuse about trying to hang on to his job and be busy raising us. He was more than intellectually capable of understanding the opportunity, and he was educated. Yet he was psychologically unable to do the rational thing. It is a riddle I've been puzzling for my entire adult life. If you're the head of a household right now, the one who's making investment decisions or the one who works with an advisor to look out for your family together with your spouse, be aware that your children will ask you in 10 years or even as soon as 2 years from now about Bitcoin. Be prepared. If you are young, time is very much on your side. Young people are much less resistant to the Bitcoin as a savings technology idea. Some hardly need any explanation. You've been given a second chance. Days are not important here, but time is accelerated. We're in a kind of a warp with the gravity of Bitcoin bending time for us. Here, weeks and months are important. Delay will be expensive when you start to calculate in retrospect. If you do not have enough knowledge to get comfortable yet, start studying. Read the Bitcoin white paper, read the Bitcoin standard, and start listening to podcasts to dig deeper. In a future letter, we will discuss the Sharpe ratio and the fact that Bitcoin has the best risk-adjusted return over a 4-year holding period of any asset ever. But even more important than that, there is one catch to this trade, and it is a very big catch. In order to receive the full blessings of Bitcoin, you have to hodl most of your Bitcoin for 2 complete market cycles. This could take 8 to 10 years. 8 to 10 years during which you will see not 1, but probably 2 drawdowns of 80 to 85%. During periods of market and potentially social and political turmoil. You will have to hold on. HODL. That means you cannot puke out your position due to your weak mentality or financial situation. You cannot let someone take your Bitcoin. Not a scammer trying to sell you something, not a friend in need, not a relative. Okay, maybe a sick loved one, you've got some medical expenses, but especially not the government. You mustn't spend it or exchange it, except for a tiny portion. Treat it like the most precious financial asset you own, as if it's already worth $1 million. That is how you hodl. HODL was originally a typo in the tweet of a drunken Bitcoiner purportedly during a market rally that has become a meme for a particular type of passionate buy and hold strategy in Bitcoin. I will cover the details of how to HODL and more on the art of the HODL in future letters. Just know that you will be tested. Your will be tested. And only the strong HODLer will come out the other side with a fortune intact. They will deserve it, whatever the haters think. This is your mission, Bitcoiner, should you choose to accept it. Until next time, keep stacking sats.